Basant Maheshwari, Portfolio Manager at Basant Maheshwari Wealth Advisors, is now joining us live. Mr. Maheshwari, it's really been long that we've spoken to you, and clearly a lot has changed. But in Jan, markets have seen great returns. Do you think it's a sort of bull market which has started again, or it's still a very selective rally sort of a market which you had defined earlier when we spoke to you?
Good morning and good to be back with you. I think the return has been because the markets fell in November, December. So basically if you compare it from say October first week to now, it's kind of a nothing market. And normally markets rally in Jan because the FIM money comes in. We've been hearing of this ever since we were in college, that January May FIIs come and then they allocate and the markets go up. In February there's a budget and then the markets go before the budget, the real stocks go up. Then after the budget, because in March there's a tax event and people have to pay taxes and the markets fall. But I think this is very much stereotyped and cliched, so that's how it is. But about the market, I don't think it's an overall integrated bull run. I think it's very difficult to formulate a thesis for an integrated overall bull run anytime soon. And the reason is, you don't have an integrated bull run when the biggest economy in the world goes in for an interest rate hike. Bull runs normally happen, on the speedboats of liquidity. So as we've discussed this before also. So when interest rates are going up in the West and you've got a Trump whom you don't know what he's done. I think it's been 20-25 days since he's been in office. And we're still counting how many more to go, maybe 730 more days to go. So what he can do in all these is very difficult. And above that, bull run happens when there is, complacency, there is negligence. How can you be complacent when one superpower is bombing out Syria and the other is doing all sorts of things with the economic setup that he has? So one is building a wall. It's very ironical that the Berlin Wall falling down was considered to be one of the biggest points of capitalism, and today the biggest capitalist country in the world is building a wall again. So the wall is still in between the bull and the real bull market.
If we look at the valuations, I was just looking at when we were around 9100 and when we are at 8800 levels. Valuations on a price to earnings have just around that level. So do you think that markets is not ignoring all these factors, or they are waiting for any new things to come from the West and only then investors would react?
So the problem with the index as such is, index is formed majorly by companies that are exporting. So, IT, pharma, they're under a cloud. So the Nifty won't move much. But if you look at the broader indices, they have been on a roll. Selectively, stocks have gone up 2, 3, 4 times over the last 2, 3 years. And companies are delivering earnings, but that's only for a limited pocket. So we might well have a situation where the Nifty doesn't show you too much and it would hide more than it reveals. But the overall broader market, you'll still get your chance to make money. But the problem in the broader market is there's a very selective group of companies that you can sit and bet on for the next 3, 4, 5 years. So most of them, like for example, the chemical stocks, the underlying thesis is, we don't own chemical obviously. So underlying thesis is there's a pollution problem in China and blah, 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 and that's why they're going up. So there are too many macro events that are formulating an investment hypothesis at the moment. So looking at that, I think selectively the broader markets should be fine. They should be doing very well. And basically in the broader market, if you look at it, it's more of the India-centric companies that are doing well. It's back to the Mera Bharat Mahan days that we used to hear when we were in college and thereabouts. So I think the domestic focused companies will be in demand. They would do well. Demonetization, we have taken the pain of demonetization. So now I think the gains of demonetization are yet to come. The gains would come because a lot of money has become white now. So people can afford to write checks, which they couldn't do earlier. And once the money has become white, they wouldn't want to go back to the old days of making it black again. So all those benefits would trickle in. The consumer-facing companies would do well, the financiers, the discretionary purchases, and anything that's domestically oriented should do well. But I think the problem is in the exporters right now. And the problem is more of the perception, not about the earnings as such. So the biggest company is having a tussle between the founders and the actually who are managing it. So that's how the thing is right now.
Right. The point that you made, you think after demonetization in FY18, there will be a lot of opportunities. You have identified Pantaloon earlier in its growth phase. But do you think organized retail could be one of the biggest beneficiaries because the unorganized market becomes less competitive?
Anything that is organized is going to just kill the unorganized space. anything. And that has been happening not now, it's been happening for the last 5, 7, 10 years. Let's take an example. Over the last 5 years, if you saw Kajaria, Serra, we don't own them, no recommendation, I'll just give you an example. So they actually increased their market share over the unorganized space. Asian Paints, not a recommendation again, that increased market share. So this process is not new, it's been happening. But after demonetization, it takes up speed. So what was happening maybe 2 years at a time now happens every year at a time. Because the unorganized space, and especially with once GST comes in, that will be very difficult for because the unorganized space, the business model of the unorganized space is to steal on taxes. It's a very harsh term, but that's what happens. So you have a tax arbitrage where that guy doesn't pay taxes and he steals across in the system, and the organized space has to pay taxes. So once GST comes in, I think the unorganized space is really in for tough times. The organized is going to take up the market, whether it's from the financing space or from all across. So obviously that space should do well, and that is why, and we as stock market investors, we benefit when the organized space does well, because those are the companies that are listed. The unorganized space, they're not listed, so we don't care too much about them.
Right. As far as the pace of market share gains via organized versus unorganized is concerned, so first demonetization and then GST. You think essentially what was going to happen in the next 3-4 years will happen in 1 year? So any of these good branded names could do very, very well?
Phenomenally well, and whether it happens on the ground or not, if the market gets a sense that it's going to happen in FY19, prices will go up in FY18. If the market gets a sense it's surely going to happen in FY20, then prices are going to go up in FY18 in any case, 2 years before. Because markets don't react without a basis normally. I mean, there is a knee-jerk reaction all the time. So the idea is, that's the advantage of being in the stock market. But if you're working on the ground, then you really have to wait. Your salary for FY19 won't come to you in FY18. But if you're invested in the market, what the company would earn in FY19, you get to reap the advantages of that 1 or 1.5 years before. So if the market gets a sense, and I think it should, that things would be better over the next 2-3 years, then this space would do well. But again, the same problem, it wouldn't show up as much in the Nifty or in the Sensex because of the heavyweight companies. But overall, on a broader scale, I think we are in for great times.
Right. Can you just tell us that, how would you identify any of these organized retail opportunities? Because, if I just look at Havells or maybe a Blue Star or any other big branded company, maybe Asian Paints as well, the valuations are very, very high. So how should one identify if one wants to take exposure into this space? What should be the sort of brand? What should be the PE or the growth rate that one is looking at?
See, first thing, in these kind of companies, Asian Paints won't grow at 25%, but the predictability of 15% growth just keeps that value. In Hindi there's a saying, "Mehenga roye ek baar, sasta roye baar baar." So it's better to get stuck in a overvalued, high quality company than try and find a cheap, undervalued stock somewhere. Because in these kind of companies, you won't make 20, 30, 40% every year, but you still get to make 15%. Even with Havells, the companies become so big. So organized is not just about Havells or Asian Paints or anything. Organized could be organized retail for that matter. I mean, we made money in Pantaloon because there was a wave there. So I don't think Pantaloon by itself was such a strong and a sound financial bet for anybody to make money, but there was an underlying thesis that organized retail would become very big. So that is one space. Organized lending can become one space. Organized diagnostics is one space where you've got these diagnostic companies, and we could be invested almost everywhere. So that's a disclaimer, obviously. So you just look around and you find there are so many things. But the bottom line is, for you to make money, we have to actually look at companies growing at 20, 30%. Anything below 20 is good enough to protect capital. But to create wealth, I think we have to look at companies which are growing at above 25%. And there are a few options there. But the problem when you look out for companies growing at 25% and above is, you don't find 20, 30, 40 companies. You'll have to restrict your universe to 8, 10, 12 companies, and then, look at it that way. So that is one bet and one risk that one has to deal with.
Right. Basant, if you could also just tell us that, if anybody does this research on organized retail, buys it now, returns could also be very back-ended. Just taking example of a Sun TV, it never really performed with Z in the last 4-5 years, but then in the last 10 days with any positive news flow coming in, it has just played a catch-up role in terms of valuations. So if the assets are good, if the brand is good, it can give you returns, maybe delayed.
Sun TV was more of a game of chance, if you ask me. Of course, we didn't participate. So somebody died and somebody walked out of prison and the stock went up. So, these kind of stocks, you cannot base any thesis on them because you don't know when somebody is going to die. You don't know when a political party is going to change fortunes and somebody else is going to rule a state. So these kind of things are almost impossible to predict without the hindsight bias. So I completely agree with you. It's not easy to do that. In India, the problem is with the media industry, of course, is that there are so many channels. I think you need an assistant with a remote to help you swap channels at some time in the evening because you just don't know which channel starts talking about what at that time. So the problem in this space is, see, organized is one part and retaining market share is another. So you have one of the biggest news broadcasters, the anchor moving away and opening one more channel for you. So there's one more thing to look at every night. So media as a space would do well, but I don't know whether the media companies would do well. So the best way to buy media is, you buy the DTH operator. So if you look at Dish TV, we don't own it, but they've not been able to report earnings as such. So if one of these Dish type companies, the cable distribution companies, if they do well, then obviously people can make money, but for them, the earnings also have to come. A business model is not enough by itself for you to make money because a good sound business model has to assure you of consistent revenue and earnings flow, which does not seem to happen there.
No, I was not essentially trying to ask about media. I was just trying to say that if anybody does any research, tries to buy any stock, even though if it's a great brand name, patience is something which is needed because something like a Sun TV gave returns after 4 years. So there is patience which is needed to buy if you buy into any stock.
No, but it gave returns after 4 years, but I haven't done the math. But if you see the last 4 years CAGR, I don't think it will be too much because the entire rally has been back-ended for the last 1 month. So we have to look at companies that go up on the basis of earnings flow, right? So not on the basis of a news flow. So news flow based stocks won't give you consistent returns over a longer period of time. So that's why we look at earnings flow stocks. So even if you're buying a brand, whatever, the brand has to make you consistent revenue year on year, month on month. Let me give you 2 examples again, since we love talking of stocks. We don't own either of them, so I can. One is Marico and one is Dabur. They don't grow at 30%. They grow at 15, 18%, very sound, very strong. And these guys know how to allocate capital. They've been doing well. Of course, there's been talk of how Patanjali is going to disrupt Dabur and all its products. But still, these 2 companies continue to do well over time. So I think these are the kind of companies which a normal investor should sit back and think and put his money in. So that's branding, that's organized, and plus there's also growth. So branding and organized without growth is like an orphan on the street. Nobody looks at him. So, that's very difficult to actually make money from. So without earnings, I don't think it makes any sense to buy anything based on the business model just.
Right. As far as IPOs are concerned, you've been very bullish about a lot of companies that have come out with IPOs. But do you think that, again, this trend of new sectors coming in, you mentioned about the diagnostic business, which was one of the best IPOs in the last 15 months or so. Do you think that more new businesses will come? And in such a market where you said that there is a lot of uncertainty, IPOs could be one of the best return given, say, if the company's fundamentals are good?
Absolutely. Last 3 years, our portfolio is formed majorly of companies that have come with IPOs in the last 15 months. So whether it's a small finance bank or housing finance companies or diagnostic companies, so we try and look around them and keep them on the radar or buy them. So we might have a vested interest in everything. So the problem with, let me give you the technical side to it. Market prices are determined by demand and supply, right? And demand and supply, the triggers for demand and supply originate from earnings. So the moment an IPO comes and the shares are spread across everywhere, say 18 shares in a demat account or 12 shares or 50 shares depending on the IPO, as the institutions get into buy, they have to lap up the shares from the retail guys. Plus, there is no overhang. Nobody is stuck at a higher price. So if the business model is good and if there is a demand for the stock, and even if it is expensive, so the stock keeps going up. And slowly as the retailers sell their stock, then the game entirely comes into the ball of the court of the institutions. So looking at that, and plus markets pay for growth. So a company with a 40 PE growing at 25%, according to me, is a better bet than a company with a 30 PE growing at 15%, because 40 PE optically might look very big, but when viewed in terms of growth, predictability, and sustainability, I think 40p is okay if you can be sure that at 25% revenue growth is going to continue over the next 2, 3, 4 years, because 25% revenue would relate in a more than 25 on the bottom line because of operating leverage and other things. So I think IPOs should not be ignored, and the retail investor shouldn't look at IPO just to make 3, 4, 5,000 rupees on an application. He should think big, and if the company is well worth it, he should just bet on it and sit on it for the next 2, 3, 4 years. And I think over the next 12 to 18 months, we are still going to have a lot of very interesting IPOs coming along.
Right. A lot of new businesses are also coming up with IPOs. So we saw BSE listing, NSE is lining up, a lot of other e-commerce is lining up. So a lot more new sectors may come in, which can trade at a premium, because right now there is no comparable.
E-commerce, I don't know. I'm not too bullish because, you don't marry somebody who doesn't have a job. So e-commerce companies are like that. So they don't have a job. So good looks can get you only that far in life. So secondly, coming back to the BSE versus the NSE thing, I think we buy sector leaders. So BSE, even though it's done well, I think it's better to look at NSE when it comes with an IPO. But NSE won't grow at 25% again. It's going to grow at 12 to 18%, but 12 to 15%. But that 15% growth is solid. See, I'm not sure whether Infosys would be there after 100 years. I'm not sure whether Reliance would be there after 200 years. But I'm sure the National Stock Exchange would be there. So the predictability, if you can call it, nothing can be more predictable than National Stock Exchange for that matter, because it's professionally run. Of course, people got in and they just blew off the Calcutta Stock Exchange, but that was 20 years back. But now with the professionalism and with the SEBI coming in, with the regulatory framework, I think National Stock Exchange is as valuable as any other sovereign asset of the government of India. Of course, it's not owned by the government of India. So these kind of companies would be an institutional delight. So at 12 to 15% top line, bottom line growth, people would still bet hard on it. The stock would trade at above normal PE ratios, and the normal guy would say, "ये तो महंगा हो गया भाई, छोड़ दो, दूसरा देखो." So somebody else would come and buy it for the predictability, because you can sit down and you can run a spreadsheet for 15 years, 20 years on a national stock exchange and say, okay, this company would be there after 15, 20 years.
Thus, Basant, as of now, in the interaction, we've spoken about companies with new age technology, new age businesses, which are growing by about 40-50%. But one of the key within your portfolio is the housing finance company. And it's definitely not a new age business. It's one of the oldest business, which has been growing year after year. Can you just tell us about housing finance company? It's still an interesting space. It's still a perpetual growing space.
Yeah, it is, and the companies have changed over the last 2 years, but the sector remains the same. So, because as I keep saying, we like companies that grow at 30-40%. So when the 30% grower becomes a 20% grower for whatever reason, we say, okay, thank you, this is all we had to spend time together, and we move on to greener pastures. So of course, we are betting on the housing finance space and betting quite aggressively with companies that are growing at 30 to 40%. So all this while, these companies, see, if you've just seen the latest interest rate reductions all across, your EMI payment and the effective cost of owning a property comes very close to renting out the property. That's for the 20, 25, up to 25 lakh rupee homes, So this last happened in India in 2002. And after that, we saw what kind of a return companies like Grah Finance and those kind of companies gave to their investors. Of course, the returns of Grah Finance was clouded because you had a Unitech growing up 500 times, or you had a L&T growing at 40-50% at that time. So there was no real compulsion for you to buy Grah Finance at that time. So these kind of companies we might be invested across. So there's the disclosure again. So the first time in 12 to 14 years, the rented cost, the rentals of a property has come down to, or rather the cost of owning a property has come down to match the rentals. It's almost there. So 50 to 100 basis points more reduction in interest rates, and it would make sense to take a long-term loan and buy a property than go on rent. And plus the government's thrust, the 3G as I call it, that is the Gaon, Garib and the Ghar. So the government's thrust on the 3G, Gaon, Garib and the Ghar. So I think that's going to put this company, and you want companies where you don't have to do too much of a research. So irrespective of anything, a secured lending business where, the companies are, where the sector itself is growing at 18%. And you have companies that say we are going to grow at 2 times, 2.5 times the sector. So it becomes very easy, and it's better to do easy stock pickings. Of course, money is never easy in the market, but you look for companies whose business models are easy. So I think to that extent, the housing finance should do phenomenally well over the next 3, 4, 5 years. It did well when there was no tailwind as such, but now we have a tailwind. So I think it can just, do very well over the next 3, 4, 5 years.
You made a point about the PE ratios and how people are saying that, sectors which have done well are expensive. That is similar to what has happened with HDFC and can happen with some of the other names which continue to perform, where valuations are pretty high, but at the same time, you would still see high growth, and that's why ownership would not change much.
Absolutely. Last 1994 or 1995, 1996 I think was the year when HDFC got listed. So of course we were in the markets, but we didn't have the brains to buy HDFC Bank. I have never seen a screaming buy report from any brokerage saying just go and buy HDFC Bank. Everybody said it was expensive, but because looking at growth and looking at the PE ratios. So similarly, there are companies who are expensive. But what happens when you buy an expensive stock growing fast is, if you are sure about the growth, in 12 to 18 months, the expensive stock becomes cheap. Not because of a fall in price, but because the new earnings that come in just reduce the PE ratio. So you have to take a leap into the future and look about it that way. So in that context, there are companies who appear expensive right now. Like for example, a Graph Finance, it used to trade at a price to book of I think 4 or 5 when we bought it. It went up to 13, 14 times price to book, and then 13 times price to book. That's not the PE ratio that the market gives to a Bank of Baroda. So these guys are trading at a price to book of 13. But that's how things are, because price to book, you cannot compare a price to book for A company with a B company. Why? Because price to book is a function of the return on equity. So a Graph Finance that generates an equity of 30% would obviously have a higher price to book than other companies. I'm doing all this for academic interest, not for recommendation, just to understand and argue as to how companies cannot be just looked at with one microscope. I mean, you have to look at it under multiple lenses, and just to see and just to say that this is at a price to book of 5 times means it's expensive. Yes Bank is one such bank again, which was always expensive. I think it was 3-4 times price to book in 2009, and from there the stock is up 30 times. And every time we said there would be a there would be an NPA problem because it is more of a corporate side lending. The bank hasn't been able to show up its CASA the way it wanted to, but the stock is up. See, once you have growth, the market doesn't care about anything. It says, get me the growth. It's like, it's like a guy who gets cash at his home every month. 2-3 months, the parents would ask him, "Kahan se paise laaye?" 4th month, everybody enjoys the money. Nobody cares a damn about where he gets the money from. So that's the unfortunate part of life, and it works in markets also.
Right. In terms of MFI industries, again, the thesis is valid. As you said, that the growth opportunity itself is very large, and demonetization has just impacted the numbers for 1 or 2 quarters.
I mean, if you look at it that way, look at it in November and December. I think there were 3 private equity deals. I think there's a company called Creation. There's a PE fund who bought stake in a Muthoot, I guess, and a Sonata Finance. It's an Uttar Pradesh-based company, and in Fusion, I guess it was. I don't remember the third one. So when the entire world and his brother were writing obituaries on the MFI space, these guys were going and writing checks to the MFI companies. So, sometimes the PE deals tell you a little more about what's going to happen, and the sector was not in fancy. So if a sector is in fancy and a PE deal is happening, it tells you about a top. But if a sector is not in fancy and a PE deal is happening, it tells you maybe that the worst is getting over. So that's the other side to it. But if you look at the overall architecture of the MFI space, so you've got the RBI, I keep mentioning this always. So RBI has formed the NHB, the National Housing Bank. So there's a Mudra Bank again. So Mudra Bank is almost equal to the NHB. So then it does lending to the MFI space, and there the NHB does lending to the overall HFC space. So I think the overall architecture of the MFI industry right now looks like it can go the HFC way over the next 3, 4, 5, 7, 10 years. And these are very solid businesses. So one of the companies, when we did a field visit, so we said, how do you check your new branches? So they said, we go to the local area, we go to the village, We will go and see the crime record. We see how many rapes, murders, dacoities happened in that area. Then we see whether the people in that area are dependent on the flood or not. So, these are the kind of overall macro analysis. After that, they open the branch there. So, they look at the general setup, the economy of a village also, and the group lending scheme. And overall, I think this space is in for bigger times. I don't know which MFI would survive over the next 5, 7, 10 years, but I think the leaders should survive. And once you have a 10-year history, then this guy, I've lent him 2 times, he's repaid me back, so I can give him a 3rd time loan also. So the vintage customer actually drives your money out. So it's better to buy an old horse in the MFI space than bet on a new horse and say, okay, he's starting business and he might grow faster. So it's always better to go bet with the old horses, and we have the old horses, and we assume that they should do very well for the next foreseeable future.
Right. Overall, do you also believe the urban infrastructure, urban NBFC players have also done well? L&T Housing has done well, Capital First, not taking any stock recommendations, but again, the matrices of ROE, ROC that you pointed out, that is something which is making them attractive versus some of the other banks as well?
When you have a net interest margin of 8-9%, you automatically tend to do well. So most of these urban financiers, they have 8, 9, 10% net interest margin. So of course, net interest margin is one aspect of the ROE ratio. So then you have the leverage and other things working. So these kind of companies, and plus money is made in unsecured lending. It looks bad to actually look at a not bad. You can just look at a company and say it does unsecured lending. What if nobody pays up? But everything is priced in for a risk. So unsecured lending will go at 16%. Secured lending, like a home loan, will go at 10.5%. So the 5.5% that you make from him should be enough to cover your losses. Lending is all about losing money as long as you make more than what you lose. So most of these urban infra players, not the urban infra players, rather the urban consumer financiers, and whatever way you want to call it, they should all do well. And in the NBFC space, the strange thing is, if 5 companies do well, the other 15 would also do well. But you want to be in those 5 companies, which, if the sector sees a headwind, should survive. So that's why you go and buy the best, because as a business, it's all about risk management. So you want to be with the guys who know how to manage risk, and that is why you choose the best. But if the sector does well, then you buy any NBFC, it's going to do well, as it happens in any other sector.
Right, but NBFCs have also shown over the period of last 4-5 quarters that any sort of problems that happen in the economy, still they are able to survive on the asset quality, except a few ones. Most of the asset qualities have been stable.
And there's a reason for this, Pankaj. If you look at it, the CIBIL report, for example. So at the click of a button, I know whether this guy has defaulted on his loans over the last 5, 7, 10 years. So, and plus I have created a database for myself. So then I go and lend more and more to those customers with whom I am comfortable, or with whom I assume that my money is going to come back. So it becomes very easy. Look at a scenario, if there were no CIBIL reports, I would just not have known. So how can you assume a urban financier to go and lend on a flat screen TV, and we say it's secured lending, and everybody knows a 1 lakh TV costs not more than 60,000 the moment you bring it home. So those 1 hour journey knocks 40% off the price. Still we say it's secured lending. Lending is secured, unsecured is one part, but even if it's a secured lending, people go on the old habits. So most of these urban financiers, they have created analytics, data mining, and they've just moved to the next level than just trying to recover money by repossessing and selling off assets. They've gone to the next level, that is trying to give loans only to people whom they feel that they would go and repay back the money to.
Right. Any other sectors that you like? So maybe pharma, maybe IT. There is a lot of underperformance by these sectors. Do you want to buy them, especially in a global environment where probably the worst seems to be in the price?
Pharma should be fine, but we owned a lot of pharma and we've sold major of them over the last several months and before the Trump victory came in. So, and IT, I think there's always the overhang, like for the 483 thing. So the moment you flash out that XYZ company has got a 483 observation. I think it seems that there's a fidine attack on the stock, and the stock loses 20%. So 483 doesn't mean that the shutters of the company are going to come down, but it just means that for the stock market, from the stock market perspective, the stock should be marked down 20% immediately. So with so much of an overhang, and plus these companies are not growing at 25-30% as we thought they would. So we made money in some and lost a few in the others. So overall, I think it was an okay kind of an experiment. It was not extraordinarily superb, as I can call it, but it was kind of okay. And so that is why it's better to be back to predictability, surety, and certainty. Then, of course, a few pharma names here and there we can own, but broadly, the romance with the sector has stopped.
Right. Just a view on the telecom pack as well. I know you always look at certainty, and there is no certainty in that sector. But with the consolidation, say if the consolidation happens, you think a lot can change in the sector in terms of pricing, in terms of the dynamics that the sector has?
No, telecom, I mean, as an industry, it's going to grow over the next 20 years. But as a shareholder, I think the West is far, far behind. It's very difficult to make money out of telecom now. And look at the kind of pricing that's happening. I think it seems somebody has got just so much cash and very little accountability what to do with the cash. So he's just trying to, he's the big whale that's going and, pushing every ship in the sea, and the ship trembles, and then the whale moves back, takes a smile, and then sees which is the next ship I can just go and touch with my fins. So if you look at what happened with Idea yesterday, I mean, it was a disaster. Why would you like to be in companies with so much of uncertainty? The certainty is that after 15 years, we will have a lot more people using telecom, a lot more people using data, a lot more people using internet, but there's always an opportunity cost for that certainty. So, and plus you don't get the growth also. So I wouldn't advise people to invest in telecom like that. We don't.
Just a word on real estate as well, Basant. The point that you made about what happened in 2002, can that happen with real estate stocks again between 2002 to 2007? What happened with some of the large cap real estate names?
No, real estate, between 2002 and 2007, there weren't so many real estate companies. When a sector is in fancy, everybody wants to do the same business. So when real estate was in fancy, so people who was doing textile merchandising, he also wanted to make housing complexes. So the first time a sector comes in fancy, most of the people leave their existing businesses to start doing the thing which is in fancy. But look at it from this point right now, is most of the companies are in so much debt, the large guys. So you can't grow fast if you are under so much of debt. One of them has virtually gone bankrupt. So, it's very difficult. But the small spaces, the small affordable housing spaces, selectively those companies would do well, but not enough to create a theme or a thesis. I think the theme would revolve around housing finance companies. We've been bullish there earlier and more now. So I think that's the theme to be in. And plus it's more of a secured lending business. So, that way I think HFCs are a better way and a better proxy to play the real estate sector than buying the real estate constructors or developers on their own.
Right. Basant, just a last word on which sectors would you be overweight on? Of course, MFI and HFCs is something that you're overweight on. But apart from NBFCs, any other sectors that you like?
I think diagnostic and anything which is organized. So I think over the next 12 to 18 months, there are a string of companies coming in the organized space. So anything which is organized, diagnostic is good. Small finance banks, as you know, I mean, we are super bullish on. So I think these are the spaces that should do phenomenally well. At least that's what we hope to.
Mr. Maheshwari, thank you so much for taking out time for us. Always good to get a perspective from you. That was a view coming in from well-known investor, Basant Maheshwari.